Can you hear me?
Yeah,
No?
Yes,
yeah, can you
we
hear me
can hear you.
perfectly?
Okay. I just want to make sure I sound good. To Nobody's got their cameras on. I have no idea what's going on over there. But if you guys will do me a favor, if you own multifamily already as an active operator, not as a syndication like passive investor, put one in the chat. If you syndicated a deal, put two in the chat. If you haven't done anything, put three in the chat. And that'll just help me as we dive into this understand who's in the room and what they're doing and how they're doing it. Bunch of threes, bunch of threes, bunch of threes. Everybody's interested. Everybody is interested. No ones. Nobody's an active operator. Come on, where my ones at? No ones? Everybody's three. Okay, there goes some ones. I see you guys. Perfect. This is good. Dang, 156 and keeps going up every second. I'm getting nervous, man. We'll see what happens. See how many people have one at the end, right? So, hey, I'm really grateful to have the opportunity to share with you guys today. Stay close to your keyboard because I'm going to ask for your feedback because I can't see you. So this will make me feel connected with you guys as I go through this. I want it to be more of a discussion than a lecture. And it looks like there's a lot of people who are here trying to figure out, hey, how do we do this? I'm glad there's a bunch of threes because some people get swept up into the syndication hype because it is all the rage. But I'm going to offer to you an alternative that I think works pretty well too. So with that, I'm going to dive into this presentation on why we prefer JVs over syndications. And as we go along, if you have questions, go ahead and drop them in the chat and we'll try to clean them up at the end if we don't stop along the way and pick them up. And so I opened this presentation with a picture of my parents because when I left corporate America back in 2016 and told them that I wasn't going to have a job, they were like, we don't know what you're doing and we don't know how you're going to survive, but go ahead and do what you feel you need to do. And so fast forward to 2 years later, and this is our first deal in Greensboro, North Carolina. We did one before that in Richmond, Virginia. And I put my last name, which is the same as my parents, on it and had them take a picture beside the sign because they didn't really know what I was doing, kind of heads down over the course of that time. And when we pulled up, they were like, why is Myers on this? And it's like, we own this. They're like, you own one of the units? No, we own the whole complex. And me and a couple of my buddies from high school and college put some money together and we were able to take this down and make a big difference. And so what I always do when I come into a group like this, because I really appreciate these types of groups because they're usually very diverse, is talk about why I started giving these talks specifically. Then we'll go into the difference between joint ventures and syndications. Give you guys some of the roadblocks that I see to getting into multifamily because there were a bunch of threes in there. Then we're going to dive into a case study. I'm going to use myself and show you guys how I was able to get into multifamily and get free from having to have a W-2 through multifamily investing using joint ventures. I'm sharing my biggest mistakes. A lot of talks won't include any mistakes. Everybody's perfect, but I feel like I wouldn't be authentic and transparent coming to you guys and not telling you how I messed up along the way. Then I'm gonna give you some free resources. We'll follow that up with Q&A. Then we'll wrap it up and send it away. With that said, I don't know anything about anything, so don't take my guidance as the gospel. You want to check with professionals like attorneys and CPAs before you do anything that you may hear from me today. So before May of 2019, you couldn't find me online anywhere, right? There was no social media presence. My website didn't have a picture of me. It was just my logo. And in essence, I was a ghost, right? I was being invisible. And what I realized by being invisible was that I was part of the problem. There are a lot of people out there, especially those folks who type three in the chat where they're like, I'm looking for somebody who looks like me on the outside so I can go talk to them and ask them questions because they make it real for me. And the reality of the situation is it doesn't really matter what the wrapping paper is, but it is helpful if somebody who looks like you has been successful because you can point to that as a case study of somebody who's done the thing. And so when I would go to different conferences, when I would go to meetups, when I would go to listen to podcasts, everybody pretty much looked the same. And this is a snapshot from a major event this summer where I was asked to buy a ticket and I didn't see anybody who looked like me. So I told the person who invited me to buy a ticket that I wasn't going to be able to purchase because I just wanted to learn from at least one person who looked like me on such a broad stage. And I had a really nice story, right? So before I left corporate America, I was fortunate enough to build a $20 million division for a Fortune 550 company. And I was employee number two. I started on January 13th. By the end of September, we had about 175 employees on my team. And by the end of the year, we did about 20 million in revenue with $6 million in profit. My reward for that was a phone call that ended on Christmas Eve right at 5 o'clock that said, Jerome, you can let other people lay them off, or you can pick the team that you're going to go forward with. And that was how I spent Christmas through New Year's in December of 2015. Fast forward to November of 2016, I was doing the same thing again. When I finished and started rolling up and putting Humpty Dumpty back together again, after we did those layoffs in 2015, early 2016, I promised myself I would never be in a position where I had to do that again. And sure enough, a few months later, I was doing it. And so that was when I decided I was going to be a corporate America dropout. And so I started doing the self-education. I wasn't fortunate enough to have a group like you guys have where, you know, you can go to work and get it all in one place. So I was listening to podcasts, reading books, doing stuff on YouTube. And through that, I was able to find my first deal. But the problem with that was the banks all turned me away. They looked at me and said I didn't have the right experience to do the project. It was a 23 unit deal. We were buying it for 1.2, and we had a pretty heavy CapEx expense that we had to do in order to raise the rents to where we wanted them to go. And long story short, they didn't care about my MBA, my professional engineering license, my project management certification. They didn't care about any of that. All they wanted to know is, had I bought a deal of similar size and executed a similar business plan in order to make them comfortable to give the money to me to do this deal. And so I had to back off and realize that I didn't have that experience. They said, Jerome, you can do this if you get a partner. I didn't know anybody who was doing this though, right? And so I just went back to YouTube and started watching more videos. And I decided, since I've been doing some hard money lending while I was in corporate America, that I would go and fix and flip. And so I started fixing and flipping. And while I was sitting on the porch of one of my fix and flip properties, a guy pulled up and he's like, let me check out the finishes in your property and make sure that we match what you're doing on the street since we're getting ready to start one. And sure enough, when we were having that conversation, he said, hey, look, we're getting ready to make an offer on a 23 unit building. I was like, that's the building I tried to buy. Please bring me into your deal. And he said, what are you going to bring? I said, well, we'll figure it out. How much money are you going to bring? I don't know. We'll figure it out. And sure enough, he went and made the offer without me. Fast forward a couple of weeks, it comes back up and he didn't get the offer accepted. He reached out to somebody else I knew who I talked to about doing the deal before. And he said, I'm only doing this deal with you if we bring Jerome into the deal too. And so that was how I got into my first deal. And so it was a group of 5 of us, and we took down this $1.2 million project. From there, we started doing more. And so I learned a ton in that process. And because I was the asset manager on that deal, my name was in the paper. And because my name was in the paper, I had a bunch of banks reaching out to me, asking me what else we had in the pipeline, uh, were we planning to refinance the deal we just bought, et cetera, et cetera. And so the tables had turned pretty drastically. While we were going through this process, we were looking for more deals and started raising money. And
What?
The red pill picture says.
We started raising money, and we went through our different we went to onto our second reposition, and that was the picture that you guys just saw my parents in. And then fast forward to last year, we started working on our first development deal. So we rezoned the land, and this week we just got some great news from the appraiser and the market study company, which basically said the development is needed and that the land was going to appraise for a lot more than what we were paying for it, which means we have some built-in equity. But the reason for telling you all this was nobody knew about any of this because I was hiding it from that very small group of local people that I had exposure to. And I'm saying that to encourage any of you who are having success in any space, whether it's in your corporate career, whether it's on stuff you're doing on the side, or you leaving and going to do stuff full time. We really need you to share your story so that other people can be inspired and know that it's possible for them. So I really, really, really encourage you guys to go in and start sharing your story. I think diversity matters. And this is a screenshot from another conference, and I was fortunate enough to be a speaker at this one. But I think people who invest in multifamily are all different sexes, all different races, all different ages. And so, regardless of where you sit, there's a spot for you to fit into the multifamily space. And with that said, or you may be asking, what does this have to do with multifamily investing, right? There isn't just one way to do this. What the majority of the press you will hear is syndication, syndication, syndication. And a lot of that was because some of the law changes back in 2012 and the ability to run things up. You heard people talking about Texas and how they bought for basically nothing and sold it for a lot. And now you're seeing it in the Carolinas and Georgia and even some stuff going on in Florida and Tennessee. And those are where a lot of capital is being invested, and still Texas to this day. But I think there are other ways, and joint ventures are the way that things were being done prior to the adjustment in the syndication laws, where they were added in those exemptions. So I just wanted to throw a few things out there for you guys. Some people want to be syndicators, and I just want to drop this on you just so that you have them. I got three uncomfortable truths. One, most people who go through the high ticket education programs never are actually a lead on a deal. And why is that important? Because if a person really wants to be an operator and they just get relegated to a passive role, I think they end up getting frustrated. And so when you're evaluating, if you do some formal education, I really, really want you to pay attention to the people who come in and are actually successful at leading deals, and how many people end up just being passive investors or people who are helping raise money. Like if you want to be an operator, make sure you go through something that's going to help you be an operator. Um, the next truth that I think is important is the majority of people who go do stuff on their own end up being self-employed, just one person, them running the company, or they have less than 10 people in their company, right? And so that means you've got a really, really high chance of being in this game all by yourself, like 95%. And so keep that in mind as you're going through this, because a lot of people are thinking about building big organizations. And the fact of the matter is, you don't have to build a big organization to do this, because you're able to put a team together and subcontract a lot of the work. And then the final one is your success is based on your resourcefulness. I've seen time and time again where people write a check thinking that they've bought a solution for their problem. But the reality of the situation is you're going to have to be resourceful. You're going to have to be nimble. You're going to have to be aggressive in your pursuit for you to actually reach that goal. And this applies not only to multifamily investment, but across the board. I hear somebody, I'm not sure if we can go on mute, but it would be really helpful because it's
I'm
distracting.
looking for the person, and if we can't find them, I might stop and say I'm going to put everybody on mute and unmute you.
Okay, it's cool. I just don't want to go off the track too bad. Okay, so this is the last slide on educators, but I just want everybody to get this point, right? Because it's all about clarity, and nobody actually shares this message. So there's a whole lot of people racing to the bottom right quadrant. They want to be investors. But if you're still in that wealth building phase, I encourage you to consider spending your time being a business owner. I think the business owners are the ones who are going to grow their wealth the fastest. They're the ones that's active and they're going to generate income. If you are happy in your W-2 and you just want something outside of the stock market to put your money in, then yeah, being an investor makes total sense. But if you want to grow your wealth outside of your W-2 and grow business outside of the W-2, then being a business owner is like super important and something that I think joint venture partners are really set up well for. The investors are the limited partners. For context of keeping this multifamily, right? Self-employed is going to be somebody who owns a property management company or is the property management company. And then the employee is the community manager that works for a property management company, just so you can kind of put the quadrants in perspective. And for you, those of you who don't know, this comes from Robert Kiyosaki's cash flow quadrant. Okay, so now we've set the stage. Let's talk about what a syndication actually is. I love comparing a syndication to a jumbo jet. So I assume the majority of folks on this call have flown at least once. And so you're walking through the terminal, you get to the gate, you give the lady your ticket, she scans it, she lets you go on to the next thing. You're on the jetway, you get on the plane, the steward or stewardess waves at you and smiles and says, welcome. You peek your head in, you look at the pilot, you wave at them too, and then you go to get on your seat and you sit there and then you just wait for them to do the stuff. As a limited partner, that's what you are. You're a passenger on the jumbo jet. The general partners are all the people who are getting paid by the airline company to make sure you get to your destination safely. And so another great example of people who are working are the people who put the bags on the plane, the people who add the food to the service area that the stewards and stewardess work from. And that is why you don't get a dollar of equity in the deal for a dollar that you invest, for every dollar of actual money that you invest, because they have to take a portion of that in order to pay the people who are responsible for actively operating that deal. Syndication or joint ventures I compare to fighter jets. So everybody on a fighter jet is going to have a job, right? Somebody might be a navigator, they might be a gunner, whatever it is, somebody has something that they're responsible for doing. But the important thing is that, they're doing more than just putting money in the deal. And I think some people try to make syndications, joint ventures by doing some things where it's like, oh yeah, he's got a job, but they don't actually have anything to do. And so what is super important for you guys to just take away is if I'm in a joint venture, I have an active role. And I think that adjusts depending on your partnership and your strengths. But it's extremely important for you to expect to do some form of work when you're in the deal. And this is great if somebody wants to be an active operator or go do their own deal later on, but start off as a partner. All right, so I won't go through all of these on both, but what I will do is do the pros on joint ventures and the cons on the syndication. So with the pros on joint ventures, I think it's easier to get the experience box checked. In fact, I will tell you that you don't get the experience box check if you do a syndication as a limited partner because you're not signing on the loan. The magical thing for a bank is for you to sign on the loan. Once you sign on the loan, they believe that you have experience and you get that magical switch that I had where I got in the paper for closing a deal and the banks were calling me, asking me about my pipeline versus me knocking on the door and them saying, get out of here, you don't have the right experience. Voting rights. The majority of people who do joint ventures set it up such that your ownership equates to the number of votes or the percentage of votes that you have when you're going through the process. And if you want to have a say in how the venture goes, you're not going to be able to have that from a limited partner's chair in a syndication. More deals available. A lot of the joint ventures are for smaller deals, just from a standpoint of capacity. If you're only putting something less than 5 people in a deal, then depending on how much capital they actually have to invest and how wealthy they are, it's going to limit the number of deal or the size of the deal you can do. With that said, earlier this year, I was in discussion to do a 233 unit joint venture with some guys that actually own that deal by themselves. So you can do big deals. You just have to have the right partners in order to come together and get financing from a bank if it's a debt deal for you. A lot of folks who do joint ventures work with sophisticated investors. And so there's accredited investor and a sophisticated investor. And those are the only two types of folks who are able to place capital in a private placement. The sophisticated investor is somebody who doesn't meet that threshold, but has the knowledge to evaluate the risk associated with the deal and make an educated decision on whether or not it fits their risk profile and time horizon. Accredited investors, and they just expanded the definition, and I'm not really up on it, but before it was a household that was, I think it was like $200,000 or $250,000 a year and $1 million in assets outside of their primary residence. For joint ventures, depending on where they are in the spectrum, the deal lead may have weaker experience. And when I say weaker, it just means less. They've probably done fewer deals, But there are some people, and I was fortunate enough, I don't know if you guys know who Dave Lindahl is, but Dave Lindahl just shifted from syndications back to joint ventures. And if you've read his Multifamily Millions or any of the other books that he's written, he's been in the game for a really long time. And he's taken the model that I just described, where he's partnered with some people who are really high net worth, and then he's doing joint ventures with those folks to do still the large deals, but with a smaller group of people. And then the final point that we've laid out here for a pro from joint ventures is I think that there's a more value add opportunity on a percentage basis. And we can dive into the numbers and I can prove that out for you guys if you like later, but just put that in that feather in your cap. On the cons for the syndication, a lot of syndications, because they want to get max exposure, they lean towards accredited investors because that gives them the opportunity to advertise broadly. And where if you do sophisticated or a B exemption, then you can only do it with people you have a pre-existing relationship with. As a limited partner, I mentioned this already, but I'll say it again. Typically, you don't have a vote. Your experience as a limited partner doesn't count for you getting a loan in the future. And because syndications require you to do larger deals, there's usually fewer deals available just from the sheer magnitude of, there's but so many 200 unit properties in a city compared to properties that are 100 units and less. So let's use me as a case study. I think everybody has to work through 4 different steps on the pyramid to getting into multifamily. And it starts with knowledge. And knowledge is foundation for everything. We want knowledge so that we can evaluate it, right? Going back to being a sophisticated investor. You want to be sophisticated whether you're accredited or not. So once you really understand what multifamily is, the risk associated with it, then you can, if you want to be an active operator, you can start looking at leads. And so these are things that may come in from brokers. You may see it on Crexy or CoStar or some other venue, online multiple listing service. And we call that lead flow. When you apply your knowledge against your lead flow and you find something that actually makes sense to buy, that's when we call it deal flow. And deal flow is something where you can actually purchase it and make money off of it. There's a lot of deals out there that are being marketed that you don't have an opportunity to really force the appreciation and be able to make a significant profit. Those are what we consider leads, and you got to do a bunch of work to them, negotiating in order to get the numbers or the math to actually work. The next one is experience. So this is the hurdle I ran into, right? I had some knowledge, I had a deal, but I went to the bank and I didn't have any experience and I didn't know anybody to partner with. And so once you figure out where you want to invest, you want to talk to some people who are investing in that area and get to start building that relationship with them so that you can have that experienced partner, especially if you're in that category of 3s. And then the last thing you need is capital, right? And capital is going to come from the bank. They're your biggest partner in the deal, but then it's also going to be from the other folks who come into the deal, especially if you're doing a joint venture. It's just going to be the people who are responsible for running it. And so that's the ladder that we walk up. And I encourage people, for those who don't have the capital, that part isn't as important as getting your knowledge and getting some lead flow so that you can be valuable to the people with experience. And then those experienced partners can usually connect the deal with the capital and their experience. And that's where the cake is actually made. So this is how I got started, right? We're walking down the path of how I got in. I was on podcasts, books, YouTube, and I was going to the RIA, but they never talked about multifamily. And you'll see that pretty often is they just want to do single family. And it's part of the reasons why I'm not super active on bigger pockets. They spend the majority of their time on stuff other than multifamily. Most days I ended up feeling confused, overwhelmed. Then I feel overconfident, and then I get frustrated because I realize I didn't know what I didn't know. And that was because I was self-educating. That was a huge mistake for me. And what I would tell anybody who wants to get into the space is find somebody to curate your base content, your base knowledge, get that foundation tight. Because what I was doing was I was listening to the guy from the north, then the guy in the mid-Atlantic, the guy in the south, the southeast, the middle west, and then out on the west coast. And they all had a different perspective. and they were all telling me how to play the game. But then when I got on the field with my ball, it didn't make sense on the stuff that I was trying to get through. And so that's why, at the end of the day, I ended up frustrated a lot. So for the deal flow standpoint, um, I got started. I went on LoopNet. I was on Crexy. I was sending direct mail letters to owners because we were looking at properties under 100 units. And I spent time networking with people who were in the space, trying to get access to deals, trying to find people who wanted to sell stuff. And the reason why I really enjoy what we're doing in the space is because we're able to help smaller operators retire, right? There's nothing better than sending a letter to somebody that's in their late 60s, early 70s, and they're thinking about retiring. They're looking for a payday, and they've got their money trapped in a building. They got equity trapped in a building. They need to liquidate it. They don't want to go to a broker, and they call and say, hey, I'm interested in talking to you about selling their property. We get a great deal. They get their equity out, and then we're able to make the investment in the property to improve the community. Because we're doing smaller deals, there's less full-time competition. And so whether I'm competing with an attorney or a doctor or a dentist or somebody, working full-time in tech, because they're doing that and I'm doing this full-time, I'm able to get to the deal quicker and go through it and make sure that it's something that we want to buy. And if it's not, then we can let other people get access to it. And again, we talked about this a little bit earlier, but because we're targeting things under 100 units, there's more deals available. From a capital standpoint, so I had some savings outside of 401k. I had access to credit lines. I had a whole life policy with some cash value. And the banks also, because it was a recourse loan, they were looking for W-2s. And so I had that for my last year of working. And then in addition to that, I partnered with friends and family to fund the down payment, and they became partners in the joint venture on the deal. I really, really like the joint ventures, and I've mentioned this already, but I just want to reiterate the point because it gives access to investors who aren't already wealthy to get in the multifamily game. Again, if you're dealing with a syndication and they're only taking accredited investors and you're not quite accredited, then you might have to sit on the sidelines. And then the final thing of the four is the experience piece, right? And so we had to personally guarantee the loan because it was a recourse loan. You remember that, my corporate experience didn't matter. And so the banks denied me. I needed to have a partner. I went over and tried to get a hard money loan because I knew that from the fix and flip world. And they told me basically my deal was too skinny. They weren't willing to lend on it. In addition to that, I didn't have experience doing what I said I was going to do. And so, and then I didn't know anything about private money. And so, I didn't understand self-directed IRAs and the way those things can fund. And so I was struggling because I didn't know anybody who owned multifamily. Fortunately, there were some folks and I kind of set them up, right? So when they put those ones in, and you know them now, right? You can reach out to them and talk to them about their deals and start picking their brain and figure out where they're investing and how you guys can do something together, right? So that's part of the reason why I do it at the beginning and wait till kind of midway through to let them know why I did that. So they can't erase it from the chat, get in, get their names, and you guys all work at Intel so you can reach out to them and just check in with them and start building that relationship. What I should have been doing, and I didn't even know that you could do these things. I should have been going to conferences. There's some educators around the country that you can go get courses from. I should have probably went to them. And there's a ton of social media groups, whether you're on Facebook, LinkedIn, and those are the two that I know the best. I guess you can call a bigger pocket social media. I'm not sure, connected investors maybe, but I would say LinkedIn, Facebook, you can get connected with people who are interested in investing in multifamily. And the whole point of this is just to expand your network of operators and get some experience and get experience on your team so that you can put together a solid package to go to the bank with. So my most costly mistake was being self-taught. It was inefficient and ineffective. I was consuming 40 hours of content each week. And so what happens is you've got this curve of diminishing returns, as you do with anything, where I would listen to 40 hours and probably only 4 hours of that 40 was new content or stuff that I hadn't thought about or I was thinking about in a different way. And you do that week after week after week. I'm talking, I did this for 3 or 4 years. You end up in a space where it's like kind of mind numbing, and you're frustrated because you could have learned this a whole lot faster had somebody condensed it and given it to you flat out. I made modeling mistakes. I remember that. So I had a property a property my parents were in front of. We modeled the taxes at $1,000, and the taxes actually ended up being $10,000. And so it's a rounding error, or I left a zero off. Great, but not a whole lot of people can write a check to fix that, because there's no way to recover that on your pro forma. It's just a big miss. And I missed it. My partners missed it. The bank missed it. It was just a mess. But we did really well on the property that year, so we were able to right size the ship. But the issue with that is because it's on my pro forma, it carries out year over year. And so that mistake is a big blunder and totally a rookie mistake on my part. Underestimating the rehab budget. You don't know everything. You go through the inspections and you get what you get, but you got to make sure that you have some contingency. And I knew that from fixing and flipping. But when you make a fix and flip mistake, say you've got an AC you underestimated by 1,000 or $2,000. When you multiply that by 23 or 100 or whatever, that becomes a really large number. It's not a small deal like it would be when you're doing a single unit. And then I hired the wrong property manager the first go around. We took somebody who was a residential property manager, gave them 28 doors to manage, and it was overwhelming for them. They didn't have the right vendors to come in and fix things, et cetera, et cetera. And so we ended up terminating them. But because of the contract we signed, they had an early termination clause in it. And we ended up paying 2 property managers for 3 months out of that first year, because we were just dissatisfied with what we were getting from the folks that we had prior to. This is important because if you're in a syndication and somebody messes up, you don't have a voice. All of these mistakes that I made, my partners and I were able to come together, brainstorm, and figure out what we wanted to do, what was the next best step. Sometimes it was just me writing a check to make the mistake right. Other times it was, well, let's make this adjustment or that adjustment, and we'll be able to take care of whatever's happening. The other thing I would say is, on that property, we bought that property for like 800,000. Had we bought that property for 8 million, that $10,000 delta on the taxes would have probably been $100,000. And so while I could write the check for the 10,000 to fix the tax situation, I would have been in a really, really tough spot to write that check for $100,000 just to pay taxes. And so every time you add a zero, it increases your risk, and just make sure that you're in a position to write a check for the mistakes that get made, because it's pretty tough going back to the people you partner with and then have them say, oh yeah, we need more money because we messed up. One of the biggest things that we like about joint ventures is our ability to be altruistic in our investment. I'm actually at my friend James's house right now, and the one thing he says is, I want my investments to make an impact. And so by being in a joint venture, we're not beholden to our shareholders to maximize our profit. We can make a decision that, hey, this person was impacted by COVID. Let's be okay with them not paying rent this month, or let's send out care packages to the complex to make sure they're good, or whatever it is. We have that latitude because it's just a group of us who can get on the phone or Zoom or however we want to meet. Sometimes it's just sending an email around and make a decision about what we think is best for our community. And that is super exciting for us. We've had some shocks along the way, and it's part of the reason why I'm so passionate about this piece of it. When we go through due diligence, and I'll just talk about the top one because I think it's most compelling. We went into a unit, and the family that was living there, they didn't have a working kitchen sink. And so what they were doing was they were taking a pot, pan, or a cup and scooping the water out of the sink and dumping it out the back door because the drain was not working, and the property owner was not willing to get it fixed because they were behind on their rent. And so what I would say is, it's great to make money in multifamily, but make sure that you don't forget the humanity of the people that you're living with. The proper channels for a lot of things is to evict or ask people to leave and give them and forgive their balance or something like that. But don't force people to live in a bad situation because you're so focused on making money. In the end, I don't believe that it works out for you as an owner long term. If you love on the property will love back on you. If you treat the property poorly, it will turn into an alligator and you'll keep feeding the alligator. And you know what happens when you feed an alligator? It gives you poop instead of feeding a goose where it lays you nice, pretty eggs. So to start to wrap this thing up, here's 10 reasons why we prefer joint ventures over syndication. One, you get to put some input into the business plan, right? There may be the person who comes up with the deal, they find it, but now that you have the deal, the team comes together and they work on the business plan. Two, you get experience, right? You sign the loan, you're involved in some of the operational decisions. And because of that, you know, you get to become a better operator, know more about what you want on your next deal, and feel like you actually have some engagement in delivering that result and driving improvement in community. We've already talked about being more involved in the operational decisions, but I'll go back to the second point and say, getting that experience is signing that loan. You want to sign that bank loan so that you've got your keys to the cool kids club. Um, this gives access to investors who aren't already wealthy, right? If you're only doing deals that are for accredited investors, then folks who are not accredited don't have access. And so for folks that I grew up with, the majority of them aren't already wealthy, they aren't already accredited. And so I wanted to give them an opportunity to come into this space so that they could start getting some of this experience and the ability to build some generational wealth. I think there are more deals available that joint ventures work for that syndications don't. There's less full-time competition on the joint venture front. We get the opportunity to help smaller operators retire. There's less risk if something goes terribly wrong. You expand your network of operators just because, you know, we're all dairy farmers, man. We're all just trying to make a few dollars on our project and make a positive impact on the community. And then the final one, which I think is super important, the biggest payday that you usually get on a project is when you sell it, right? There's some cash flow along the way, but you get that really big, nice bump when you sell it because you force the appreciation, hopefully, on your deal. And so you want more back-end buyers interested in the property that you have for sale. And I say that to say, you know, I can sell my property to a doctor or a dentist, or I can sell it to a group of guys or gals who are doing a joint venture, or depending on the size of the property, I could sell it to a group of syndicators. And I enjoy that versus only being stuck selling to syndicators or only being stuck selling to joint venture folks. So my big question for you guys is, do you want to be a fighter jet pilot or on an Airbus? I personally grew up near an Army base with fighter jets flying over my house just about every day. And I wanted to be a fighter jet pilot, but I ended up being too tall. Just about us, man. We have 3 operating companies where we do some coaching. We run on multifamily investing because I'm actually an operator. I don't just teach. And then we do some real estate education. And we've got 2 live events. One's a mastermind for dads in multifamily. And we've got a conference that happens in March of each year. And I want to give you guys some free resources if you're up for it. So Multifamily Missteps is a podcast that we started at the beginning of COVID. And what happened, if you think about that 40 hours of content I was consuming every week, I heard over and over again that everybody made money, they didn't make any mistakes, and everything was perfect. And that just drove me up the wall because I was making mistakes and I didn't understand why. And so we started a podcast where we get the war stories from operators from all over the country. And some are huge, some are small. But the goal is to show you the risks that are inherent in multifamily investing so that you can come into the space eyes wide open. We're pulling back the veil and letting you know the stuff that happens so that you can go out and be more educated as you go through the space. And then Dreamcatchers is a podcast, and we tell the story of people who exited the Matrix somebody mentioned earlier that I'm wearing a shirt that says I took the red pill. And, The Matrix was one of my favorite movies. But the goal here is just to inspire folks and let them know that their dreams can be real. And now here's a person that did it. Not only did they do it and they're great now, but here's how they did it. And here are the struggles that they endured along the way. Because I think that part is what allows somebody to actually get the courage to create and manifest that future that they want. And I've got a free 4-step guide for you to learn more about these JVs and syndications at myersmethods.com. And there you can get a bunch of other freebies as well. So that's the end of the prepared content. How did I do on time? 44. Perfect.
Yeah, we've got time if anybody has any questions that they want to ask Jerome.
Please ask me some questions.
And you'll have to unmute yourself, of course.
I have a quick question.
Yeah.
Jerome, thank you very much for this. Very helpful. Do you have your real estate license, realtor's license?
No.
Would you find it more? Have you found areas where it would be more beneficial if you did?
So we only use agents to sell our stuff because we want to get max exposure. When we're prospecting, we don't use agents. Let me take that back. We prefer not to use agents. We prefer to work directly with sellers. And so, no, I don't really see an upside in that other than being able to charge the transaction fee. But we take a discounted fee, so we'll take somewhere between 1% and 2% for finding the deal as an acquisition fee and putting the full structure together.
Okay, thank you.
So Jerome, I have a question. So the question to you is that because you are an active investor and also you're doing this in partnership, you're still new in terms of doing this business. The question that I have is the properties that you own. What do you say about someone owning the properties, multifamily, single family, or combination of that? So question is that, do you think that is a good idea for an investor to own and manage himself? Like, if you manage yourself, you can save a lot of money versus giving to the property manager. Property managers, what I find that they mostly spend time on making money for themselves, getting the money like 10%, 8%, whatever you say, and then getting money from the leasing, 1 month rent or half month rent. So a lot of money goes there, but they don't do much job in taking care of the properties. So if I do myself, it's savings plus but at the same time it's a lot of time that I spend. Question to you is that, what do you think from your opinion is that, is this a good idea to give it to the property managers and spend more time in investing, growth and stuff like that, or do both?
I absolutely encourage everybody who's not a professional property manager to not be a property manager. And when you look at the amount of time that you'll spend, and you have to figure out what your rate is. And once you figure out what your rate is, and you think about how much time you're allocating to property management tasks, and you compare that against how much you pay the property manager each month, I can guarantee you that you won't see it as you're making money by saving the 8, 10, 6, whatever the percentage is. The other thing I will encourage you to do is find a property manager who will manage your property for free, or not free, but a flat fee, right? So we pay our property manager 8%. It covers everything. There is no lease up fee. There is no renewal fee. There are no fees. There's no markup on subcontractors if they coordinate something. It's just nice, clean billing. They collect $10,000 this month. They make $800 off their property that month. And we just keep rolling like that. And I do have a property manager on one of our properties who charges 6.5% to manage, but they take a half a month's fee. I was vehemently against that when we were going into the deal, but my other partners agreed that they should be able to get that. And that property manager usually takes a full month's rent when they lease. When you do that, when I looked at the numbers for what that cost us, it basically, they made more money off of leasing fees than they did off of property management for the year. So you paying a higher percentage, but not giving them money for stuff that they should be doing anyway, an additional fee or taking a piece of your rent for the month, I think is really the answer. And every property manager has their challenges. They're not going to be perfect, but if you're doing it, you're not going to be perfect either. So you got to take your punches.
So you are saying that maybe it's good that I give them the percent, so the monthly or half month, whatever the leasing fee, and reduced, management fee. That might be the best way to go.
I wouldn't do that. I would pay a higher percentage on a monthly basis of the revenue
Okay.
and pay them nothing for leasing. See, when you, the way I think about it, and it's more corporate psychology than anything, when you incentivize the behavior by paying somebody to do it, then they do it. So why would somebody be incentivized to retain the folks who are in your property if they only get paid if they get new leases written?
But if you don't pay them the leasing fee, will they be motivated to rent out sooner?
Yes, because the collected revenue is how they make the majority of their money.
I
So
see.
they want it full so that they can collect the revenue.
I see. And you also mentioned that you suffered by the property managers because they did not have a proper resource. So, in terms of finding a property manager, should I consider that the management company who has larger portfolio than a smaller portfolio because then they have more resources to get that job done?
So you have to find the property manager that fits what you want done. Just because they have more resources, say you bring them a 10 unit, they may not be interested in you and your property, right? So you got to make sure that they're going to actually give you the attention you need based on the size of the account that you're bringing. You know, we like to be in the upper middle tier of door count for whoever they're working so that we can get the owner on the phone or we can get the regional on the phone and get our problem resolved and make sure that they're paying attention to it because they don't want our business to leave. When you're smaller, you know, if you're small and you go to a big company, it's likely that you're not going to get much attention, even if you need it.
So, in other words, if I have
Hey,
100
Jerome,
units,
question. Oh, so go ahead.
sorry, it would be my last question. So if I have 100 units, are you suggesting that I should not, diversify, let's say 5 property managers versus, giving all of to one property manager? Because there is a risk of giving everything to one management company versus giving to 5. So what is your opinion on that?
Yeah, I mean, as long as the property management company isn't like dependent on one person, like it's actually a company, then and you like the service that you're getting, I want you to continue to build your portfolio with that company because they've already got the systems and processes put together and they know what you expect as an owner. If you're going from here to there, then you got a different call for every property. You Things may not be standardized across. It may be a good learning opportunity, but that's kind of where it stops, right? And so I think sometimes we try to over optimize. We're diversifying this and we're getting synchronies from that when we really just want to figure out how we want it to run and get somebody to deliver that result for us. And so that's what I'm looking for. I want one throat to choke. It's one phone call for everything in Greensboro. It's one phone call for everything in Richmond because the companies don't cover the same area.
I have a super last question. I'm sorry. I said that was my super last question is that if you want to diversify yourself or expand yourself, would you be, focusing on one area or you want to go to multiple states?
Yeah, I like when I hear people talk about going to multiple states, but again, I don't know how you can really know the market the way that you need to know the market in order to make the investment when you do that. If somebody gives me a street address, I can tell you what the rent should be for that property without ever going there, without seeing it. I know what the rents can do. I can't do that across 5 markets, let alone 5 states. So I want you to become the expert on the state that you're investing or the market that you're investing in. And it's not even the city, right? Because there's different quadrants and different neighborhoods within the city that you may want to invest in. Like from my perspective, real estate is super local. And so when you place your bet, you want to make sure that you truly understand the momentum of that area. And I think it's really difficult to pick that up from the census data or any of the other online resources.
Thank you.
I wanted
Those
to
are
say I
good
really,
questions. Jerome, a quick question for you. With low interest rates right now, are you seeing, I've seen it sort of the larger end of syndicated deals, more competition, just more money flowing into real estate, right, to look for yield. What are you seeing in the market? You talked about doing smaller deals. What are you seeing in your market as a result of interest rates being low? Are you seeing more competition, or what trends are you observing?
Yeah, I don't think the competition is driven by the interest rates as much as it's more people are finding out about the asset class and seeing the money that people are making who bought in 2010 to 2012. The interest rates are nice, but I mean, they're only fixed for 5 years. So you're able to pay more for a deal because your debt service coverage ratio is lower. So the debt allows the deal to work. But that isn't, from my perspective, it's not the driving factor. It's becoming more popular, and it's an alternative to the stock market. I think a lot of people are trying to get away from the stock market.
Thank you.
In terms of leases and property management, in some respects, it's more of an art than a science. So, for example, if someone's affected due to COVID, they could potentially try to not pay rent. Where do you draw the line in terms of giving a normal amount of leeway versus understanding that someone's taking you for a ride and intending to squat and take advantage of you? I guess what's your decision-making process, and then any examples maybe?
Yeah, so as long as a person keeps their promises, then they have a place to stay in our environment, in our communities. With that said, I mean, there are people who have taken advantage of us. We've had at least 2 people move out and they owed us over $6,000 apiece. And so there's but so much you can do. And with the CDC order, not paying rent isn't a reason that a person can be evicted at this juncture. So what we do is we have people, we make sure that they have applied for all the assistance programs that are available. We make sure that they are making an agreement to pay something, and then we make sure that they pay. If they pay what they agreed to pay, then we let it go. If not, then we move to evict them because, I mean, they know that they have to pay at some point unless they just move out in the middle of the night. So it's a case by case basis. And one of the things that we've evaluated, because a lot of our residents have been with us for longer than a year, is what was their history before COVID? Were they paying us? And do they have a legitimate reason? Did they lose their job? Were they sick? Those types of things. And if they were, then we're even more lenient than we would be if somebody was a poor renter beforehand and they continue that habit now, but they feel like they can be even worse because there isn't anything that's hanging over their head as a consequence. In general, I believe that the majority of people want to pay their bills. In general, I believe that the majority of people who have the capacity to pay rent will pay rent because they need a place to live. And we've not given them a holiday. We've given them a reprieve so that they can get their stuff together because of the impacts from the virus.
Hi, Jerome. On the COVID topic, have you seen or do you see the potential for, lots of folks are moving or working from home now, and they need, an augmented infrastructure in terms of like wireless, things like that. Have you seen that as being a potential pressure to maybe invest more in CapEx to make your product, competitive, to command higher rents, or maybe you haven't seen any of that influence?
Yeah, I mean, we have one property where we provide internet for the residents, but I mean, just at the most basic level, if they want to get, if they get their cable package or they get their internet package in their unit, you know, they can pay that bill themselves, right? Offering free Wi-Fi, and especially for a whole building, it's probably not going to be solid bandwidth. It's going to have some issues. It's kind of funky. So if they're trying to do that to run a big Zoom meeting or something like that, they're going to have issues just because there's too many people on the line. So no, we haven't had anybody asking us for that. And I think it might be because we focus on workforce housing, right? We're looking for those blue collar workers who are, I know you guys are in different areas in the country, but the median income in North Carolina is $50,000. We're looking for people making 30 to 50 grand a year to come live in our properties. And the majority of them probably aren't doing computer work from home unless they're
Got it.
teachers.
Thanks.
All right, we have about 30 seconds left. I wanted to thank Jerome for coming and presenting and telling us all about his multifamily journey, and make sure you check out his site as well. So thank you, everybody, for coming.
Thank you.
Thank you very much.
Great stuff.
Thank you, everyone.
Thank you.
That was great.
Yep. Thank you, Jerome.
That's
And
great.
Daniel.
Thank you.
Yes, thanks,
Hey,
Jerome.
Daniel. Quick question. Will you be posting the slides after?
Yes. So, Jerome, I assume I've got your permission to post slides and contact information, and yeah.
Sure.
Yeah. So just go to our SharePoint site, and if it's not abundantly obvious where it is, the SharePoint site is brand new. Just send us some feedback. I'd love to change it and make it work for people.
Yeah, of course. Yeah, I actually don't know where the SharePoint site is, so I can probably just go ahead and IM you after, and you can let me know.
I'll
All right.
drop it in the chat box right here.
Oh, perfect. Perfect. Thank you so much. And thank you so much, Jerome. It was really helpful.
Thanks, guys.
Thanks, Jerome. It was amazing. Thank you.
All right. Well, I guess I'll go ahead and end the meeting then. Thank you, everybody.
Thanks.
Thank you, Jerome.
Thank you, Jerome.
Thank you.